My name is Casher Nunez, and today we're going to be talking about the power of lifecycle funds within the thrift savings plan. Let's cash in.
Finance for the everyday millennial. Hard charging solutions. We provide an accelerant in the journey towards financial independence.
Each of the 11 funds is a diversified mix of the 5 individual funds, G, F, C, S, and I. They were designed to let you invest your entire portfolio in a single L fund and get the best expected return for the amount of expected risk that is appropriate for you. Every quarter, the target allocations of all the L funds except L income are automatically adjusted, gradually shifting them from higher risk and reward to lower risk and reward as they get closer to their target dates. When an L fund reaches its target date, it goes out of existence and any money in it becomes a part of the L income fund, which generally keeps the same target allocation. For example, in 2025, the L 2025 fund will roll into the L income fund. One of the important things about the L funds is that they stick to their target allocations for a full quarter, regardless of what the markets do. Every trading day, some of the individual funds in an L fund will do better than others. At the end of the day, the individual funds that did better will make up a higher percentage of the L fund than the ones that did less well. To maintain each L fund's target allocation, the good people at the Thrift Savings Plan rebalance it at the end of every trading day. They do this by buying and selling the individual funds that make up the L fund so that the percentages go back to what they were at the beginning of the day. In effect, they're buying low and selling high at the end of every trading day. Okay, now let's take a look at what the historical returns have been for the L funds you're most likely to be investing in. All right, let's jump into comparing 3 funds within the several lifecycle funds that are available to us at the time of this recording. So as you can see on my screen here, you have the L Income Fund, which is the fund that you're going to be in as you start to take distributions from your thrift savings plan. You have the L 2025 fund, that's the target date. You have the L 2030, 2035, 2040, 2045, 2050, 55, so on and so forth, all the way up to 2070. And those are the target dates of retirement. And so as you can see here, the objective for participants who were born between the years 1985 and 1989, or will withdraw their money beginning 2048 through 2052, the target date here is 2050. So if your expectation is to start taking distributions in the years 2048 or 2052, or if you were born around the years 1985 or 1989, they give you 2 different ways to kind of do that math, you should be investing in the L 2050. The objective changes based on the target date, right? The years that you were born change, and then the years where you expect to take withdrawals or distributions changes as well. Based on the demographics that we are primarily speaking to, we are expecting people to be born around the late 80s, mid 90s to late 90s, all right? And the expectation is that you're gonna start to take distributions in 2048 or a little bit later. So we have pulled up these 3 target retirement or life cycle funds, 2050, 2055, and 2060 for that reason. So now let's look at the returns of each one of these in depth. So first we're gonna zoom in on the L 2050 fund, go straight to performance and risk. And we can see here that the year-to-date return is 14%, and the L income return is 7%. So if you were taking distributions, you're looking at 7%, but if you're not taking distributions and you're still, investing, making contributions into your lifecycle fund, you should expect a return of about 14% year-to-date. Lifetime return has been about 9.5%, which is pretty good. Because if you've been investing for the last 20 or so years, to be earning 9.5% is not bad. You're definitely beating inflation year over year, right? And as you get further away from retirement, so as you get further away from taking distributions from your employer-sponsored plan, your TSP, the amount of risk you're taking is greater, which means the amount of reward that you should be expecting is greater. So you'll see, you know, right now we started with 2050. Once we go to 2055, those rates should be going up. And once we get to 2060, those rates should be going up again. What is the composition? So inside each one of these life cycle funds, you have the G, F, C, S, and I funds. We have a video on the SC and I funds, which we highly recommend, especially the C fund, right? So if you want to hear specifics on what makes up the C fund, the S fund, or the I fund, I would highly encourage you to go and watch that video. But if you look at this lifecycle fund here, the L2050, the allocation is primarily C fund. You see in the year 2026 or 2025, excuse me, it's still primarily C fund. You see a little bit of I fund here at 25%. You see a little bit of S fund at, let's call it 15%. And then you see some G and some F, right? And as you can see, as you get closer to receiving distributions, they rebalance the portfolio to be more and more conservative. They put more and more money in the G fund, more and more money in the F fund, and move money from the higher risk fund of the SC and I into those funds. So if you're taking out money in 2050, they want to make sure that a potential downward swing in and around those years doesn't impact your ability to take distributions and to live off of the money that's been growing for all the years that you've been contributing to it. So that is the composition of the L2050 fund. What do the fees look like? We've got a net administrative expense ratio of 48 cents for every $1,000 invested, the exact same administrative expense as the SC and I funds. You have the investment expense ratio, 50 cents on every $1,000 invested, for a total expense ratio of about 53 cents or 5.3 basis points. So 53 cents on every $1,000 invested. That's very, very low, right? And if we go to the summary tab, we can see that this Lifecycle 2050 fund has about $39 billion in assets under management. The inception date was 2011, and its current allocation targets have it majority in the C fund, and it's followed by the I fund. So this is heavy on international, which is probably bringing it down a little bit. And then you have the next highest allocation of going to the G fund at 11%, and then the S fund at close to 11%. So that's the L2050 fund in a nutshell. If we move to 2055, like I said, it should be a little bit more risky in terms of the composition. So we're gonna go straight to the composition, and there you go, right? It's heavily in the C and the I fund. Those are the riskiest funds of the G, F, S, C, and I funds. The C, S, and I funds are the riskiest funds. But with that risk, the expectation is that you have a much higher return, which is exactly what you need in your earlier years. And again, as you get closer to taking distributions, as you get closer to retirement, it starts to move more and more conservatively. So right now, we're in the year 2025, just starting it. You know, 0.5% is in the G fund. The G fund is government bonds, so it's extremely safe. And then you have the S fund at 50%, the I fund at 35%, and the S fund at 13%. And as we get closer and closer and closer to retirement, you see the G fund going from 0.5% to 5%, from 5% all the way to 10%, from 10% to 15%, and that S fund, or excuse me, that C fund going from 50% down to 40%. And you could see the adjustments here, right? High risk to low risk, high reward to low reward, because it's all about preserving capital as we get closer to retirement. So that is the basic mechanics of the Lifecycle 2055 fund. The net administrative expense ratio is 47 cents, so it's a cent cheaper for every $1,000 invested. The investment expense ratio, 60 cents, and 6 cents. And the total expense ratio is 54 cents for every $1,000 invested. All right. And let's see the performance risks. So right now, year to date is 16%. That's slightly higher than the 2050 because it's in riskier investments. And right now, those investments are enjoying higher rewards. And if we go to the summary here, the allocation targets are right here, right? You got the C fund at a little over half. You've got the S fund at 13% and the I fund at 35%. Barely anything in G, barely anything in F. 2055, you know, at the time of this recording, it's 30 years away. So you want to stay risky. You want to enjoy the amount of rewards that you're going to receive as a consequence of staying risky for as long as possible, and then start to shift. All right, so I think that sums up 2055. And now we're going to go to 2060, where we should see the trend continue. So let's look at the composition right now. In 2025, it's a little bit higher, right? It's a little bit higher at 51% in the C, just a little bit. I fund seems to be about the same, 35%. S fund about the same, 12.8, which is basically 13%. We saw these numbers in the 2055 fund. And then again, that trend line, the closer you get to distributions, the closer you get to retirement, you start to shift the risk from high risk to low risk and high reward to low reward, because it's all about preservation of capital. Fees here, 47 cents for every $1,000 invested, and 6 cents in the investment expense ratio, for a total expense ratio of 54 cents for every $1,000 invested. Very low. The performance risks, about 16% year to date right now. It's very close to the 2055. And the L income fund is still at 7.3% if you were taking distributions. So right now, it doesn't look like there's a huge difference between the L 2055 and the L 2060. So my recommendation, the 2060, because you are going to start to see a difference in rebalancing as you get closer to those target dates, which means you're keeping your money in higher risk assets for a little bit longer. The 2055 will start to skew more conservatively faster than the 2060 would. And again, if you're watching this in your mid to late 20s, early 30s, even mid 30s, you definitely have plenty of time to keep all of your contributions, all the money you're putting into the thrift savings plan, in high risk assets so that you can reap the rewards of those investments. And so again, 2060, you continue to contribute using the dollar cost averaging method that we teach. We also have a video explaining what it means to dollar cost average. Highly encourage you to go watch that for more specifics. But the 2060 of all these is what I would recommend people invest in if they are in those age ranges of mid 20s to mid 30s, because you have the time. You should definitely be engaged in the risk so that you can reap the rewards of taking on that risk. And then you can always reallocate from the 2060 down to a 2035 or a 2040 if you decide that you would like to start taking distributions. Keep in mind, there is a penalty if you take distributions from your retirement account before the age 59 and a half. That could be, so you could be penalized on it, 10% penalty, and all the distributions you take are subject to earned income tax rates. So there are some penalties there. So before you do any of that, I would highly encourage you to give us a call and we can talk you through what that might look like. For some people, it still might make sense for you to incur that penalty if you need the money, or if you know you're not going to have any other method of receiving income at the time in which you need it. This might be the only opportunity that you have. And so pick up the phone, give us a call, or send us an email at contact@rhinoinvest.co, or go to our site, rhinoinvest.co, and set up a free 30-minute consultation and we'll talk you through it. All right, and I want to end this video with the comparison of the three funds, the 2050, the 2055, and the 2060. Here's the trend line, right? The return year to date, 14% on the L 2050. It's closer to the target retirement, so things are becoming more conservative. Jumps up to 16.28% when you get into 2055, and it stays there at 2060. That's going to be different. You're going to see three different numbers in 5 years. 2055 is going to move more conservatively than 2060, faster. And so those three numbers will be different. in about 5 years. The risk for all of them is still considered to be high because the out years are just so far away. 25 years is the nearest target date for this life cycle fund in 2050. And the expense ratio is more or less the same, right? It's a little more expensive to invest in the 2055 and 2060 than the 2050, but we're talking literally a penny for every $1,000 invested. So it's not that big of a deal. All right. And if you were so inclined, you can go to tsp.gov, click on fund options, and then click on lifecycle funds, and it'll take you right here to what I'm showing you. And you can select which 3 funds that you would like to compare, just to kind of give you an idea of what the composition of the fund is, what the historical returns have been, so that you can make the best, most informed decision for yourself. My name is Cashin Nunez. I'm a financial planner, real estate investor, mortgage loan originator. I hope that you have received some valuable information from this video. If you have, please hit the like button, subscribe to the channel, hit the notification bell. We are constantly producing content, not just on the TSP, but on VA home loans, a certificate of eligibility for those home loans, VA education benefits, disability benefits, all the things that you want to know as a member, current or former of the United States military. We are bringing that information to you on a weekly basis. So again, thank you for your time, and I look forward to seeing you again.
The RINO Invest and Cash In with Cashin YouTube channels are hosted by Cashin Nunez. Cashin Nunez is a financial planner with RINO Invest Wealth Management. RINO Invest Wealth Management is a registered investment advisory firm regulated by the Securities Division of the State of Georgia in accordance and compliance with the securities laws and regulations. RINO Invest Wealth Management does not render or offer to render personalized investment or tax advice through the RINO Invest and Cash In with Cash In YouTube channels. The information provided is for informational purposes only, may not be suitable for all investors, and does not constitute financial, tax, investment, or legal advice. All investments involve a degree of risk, including the risk of loss.